Good afternoon, everyone. Welcome to another episode of the Live Econ Guy. In this video, guys, I want to talk about prices and when will prices normalize. There's been a lot of discussion about generally when will the price of things like goods and services go back down. We've heard a lot of news about inflation growth moderating, so people are starting to wonder, hey, when can we expect prices to ease a little bit because everything is getting so expensive. Now, a lot of people and a lot of analysts are saying that, the things of prices, goods and services, they will not decrease, because we're aiming at 2% inflation, so things will generally stay the same as they are right now and continue to go up in price. So I want to share this article with you. CNN Business, they're pretty much saying inflation is coming down. That doesn't mean that price of stuff will decrease. So essentially they're saying exactly the same thing that I'm kind of saying, is that inflation falls to 2%, everything will still be going up. So they're saying that things won't go down if inflation goes down to 2%. And they did this for a poll, so they're kind of discussing things like disinflation, deflation, the dangers of deflation. So the deflation is in many ways more dangerous than inflation, they're saying, and that's basically where the price of cash goes up relative to other things. So generally, I disagree with this view right here that things will continue to go up and they won't go down or moderate, and I'll explain why in a bit. But for the most part, in recent history, things did continue to go up. So if you compare it to 20 years ago, maybe in the year 2000, things were much cheaper on average than they are today, unless you factor in things like Arizona green tea or the Costco hot dog. Overall, things are more pricier, and I want to look at some kind of data. So this is average prices of Big Macs in the US, and it started being tracked in the year 2000. And once again, this is an average, so it's looking at all the cities and counties in the United States. So but generally, if you look at this, the price trajectory is that it goes up over time. So kind of just looking at that, you will kind of assume that, hey, in this situation that we are in today, yes, there's inflation. Yes, things are expensive. Borrowing costs are expensive. Everything is expensive, and it won't go down. It'll just continue to either be flat or go up. So looking at this again, I think this time we're in a different situation, and here's why. So we have the M2 money supply, and this is the Federal Reserve website. So if you look, since it started being tracked in the 1960s, the M2 money supply only increased since this started being tracked. It never, or is relatively flat. It never decreased like it currently is. And this is since basically July of 2022. So I think a big part of why this is happening is because the Fed is allowing assets to roll off of their balance sheet, and they're essentially soaking cash out of the system. So I think this is pretty big, and M2 money supply is generally a predictor of inflation. So if there's a large growth of M2 money supply in period 1, then in period 2 you can expect an elevated growth of inflation. So this time around, because M2 money supply is shrinking, I think this could result in prices going down. Currently, the situation that we have is we still have inflation, so businesses are greedy, which kind of how I think a lot of things started. If you go to our grocery store, the owners of these stores, they heard that there's going to be inflation, so they started raising prices just to do it because of corporate greed. There's a lot of articles about this. So you have prices of goods and services going up, and at the same time you have interest rates going up, which means it's more expensive to borrow. So consumers are getting hit from both sides. You have prices going up, and you have the costs of borrowing going up. So things are, in real terms, if you calculate, things are way more expensive than just inflation. So I think this is gonna have a kind of a cascade effect where things are going to start moderating, because it's just going to be too expensive to buy anything, really. A big component of what's happening today is the jobs market. It's really strong. I think I made a video about this, and I think a big reason why the jobs market is so tight today is that during the pandemic, a lot of people left their traditional jobs and they went to work for various startups. They started their own businesses, etc. So liquidity is starting to dry up, as you can see from this chart. Credit conditions are getting way tighter, so I think the expectation is that a lot of these new startups, they're going to start closing down. People are going to start going back to their traditional jobs that they worked pre-pandemic, and that's going to essentially loosen the labor market, and essentially it's going to result in much lower wages. And at the same time, you have higher costs of borrowing, you have prices of goods going up, people are not going to be able to afford them, so supply and demand, it's going to be a demand shock, which is going to result in lower prices of goods. Yeah, that's my analysis, guys. I also want to share this article right here. It's by this organization, WRAL News, and it's from May of this year, and kind of the question that they're posing is, did your credit card limit get lowered? 5 on your side explains why and what you can do. So I think a reason for this article is that, going back to this chart, the M2 money supply, this is essentially a lot of what this is banks having cash to lend out. So not only are loans becoming harder to qualify for with the higher interest rates, but banks also have less money to lend. So it's kind of a double-edged sword, where banks are starting to have higher qualifications to get a loan. So I think what's going to start to happen again, and this happened during the pandemic, is that banks are going to start to slash credit card limits. So this organization is kind of telling people what you can do about your limit getting lowered, things like that. So not only is borrowing getting more expensive, it's also getting it's not as easy to get that liquidity and credit. So yeah, in general, I think I disagree with this kind of general perception that prices will continue to either stay the same or only go up. I think because of this trend that we're entering, where liquidity is exiting the system, cash is exiting the system, I think this is going to predict some deflationary shocks, and because of that, it's going to result in lower prices in the future. So that's my prediction, and that's my analysis. Thank you for joining me. Please let me know what you think in the comments down below. Generally interested in knowing what everyone thinks. I'll leave the links for all of these articles and kind of sources that I shared with you all down in the video description below. Have a great rest of your day.